Hi, this is Mark Melling with Melling Insurance, and my discussion today is which is better to have, a term life policy or a permanent life policy. And I say, how about a combination of both? Now, I do understand that not one policy fits all, so this presentation is more geared toward a young family with children. Okay, so when I get a customer with a young family with children in my office, they're going to say, okay, well, Mark, what's the difference between a term life policy and a permanent life policy? Great question. A term life policy lasts from 5, 10, 15, 20, 30 years, and the policy ends. It has no cash value, and after the term that the insured chooses from, it ends. Now you compare that to a permanent life policy that's basically term insurance and you're investing the difference. Okay, the investing the difference, it's money that's building up called cash value, and that money is growing tax deferred throughout their life. So as long as the insured is making their monthly premiums, the policy continues. Now there's several different types of permanent life policies. There's a universal life policy, a whole life policy, index universal life policy, and variable universal life policy. Which product is better to have? Well, it depends on the customer. If they're more risk averse, they don't want to take any risk, then they're going to be more geared toward a universal life and a whole life policy, which gives you about a 3 to 4% rate of return each year in fixed products. Okay, if they want to take on more risk, then they're going to do what's called a universal equity life policy, indexed life policy, which is more following an index. That's exactly, it's an index universal life policy. You're going to follow, you're going to have your investment following an index like the S&P 500. So if the S&P 500 does a 12% rate of return for the year, you're going to get 12% back. If the S&P 500 does a 20% rate of return, you're going to get 12% rate of return back. So there's a cap on how much money, the maximum that you can obtain. What I like about these products is that if the S&P does do a negative return, say it does a negative 5, 10, 15% rate of return, then the maximum you can lose is 0. So 0 is your hero with those products. Now, what I'll get is they'll say, a few of my customers will say, well, Mark, I want to do even better than that. I want to maximize my return even more. Then what you're looking at is called a variable universal life, and with that type of policy, you can pick the basket of goods you want. So you can do a basket of stocks, or you can do a basket of bonds, or a basket, or maybe like the money market account. So you have your choices there. So if you're trying to maximize your rate of return and you want to do better than an index universal life, then of course the basket of goods you're going to choose would most likely be the stock basket of goods and services. So if you do choose that, and that's all great, but again, what you got to look at is the downside. So if those stocks do negative for the year, then that can dip into your principal of your cash value. So that's basically how that works. Okay, so the question is, Mark, why a combination life policy for a young family? And there's several reasons why. First, none of us know when we're going to die. Right? So our life insurance needs change throughout our life. We may get a bigger house someday, or it may be a first purchase home, so you're going to need life insurance for that. Throughout life we may have more children, we may start a business, so there's always changing circumstances where you may need more life insurance. Second, the market today is much more volatile. I'm sorry to say, but this is not our parents' or our grandparents' economy. The nation has much more debt. The Federal Reserve, they're printing money out of thin air called quantitative easing. You look at the job market, it's much more scarce. There's a lot of people that aren't even counted in the statistics anymore when it comes to the unemployment rate. So our parents' age and grandparents, when they got out of school, they got a job, they worked for a company 35, 40 years, and then when they retired at age 65, okay, the goal is, okay, I'm going to have all my house paid off, my children will be gone, all my credit card debt will be paid off. So the only really uses I'll have for term insurance would be for my funeral expenses, called final expense insurance. Everything's going to be, and that's it. I'll live off my 401k and my IRAs. Well, with so much uncertainty today in our era, we may have that need for permanent insurance by the time we're age 65. So again, that young family with children just starting out, you're going to want that combination, permanent and term insurance, what a lot of young families like to do. So with that said, the last thing I look at is that cash value building up tax deferred over the years. There's a lot of ways you can use that money over the years that's accumulated. You can borrow. What you're doing is you're borrowing against your cash value. And let me say this: when you're borrowing against your cash value, it's at a very low interest rate, usually less than 0.5%, which is great, better than what you can get at a bank. And that money can be used to fund your children's college education. So they say, hey, mom and dad, I want to use that. I'm going to go to college. I need some money. So you can borrow against your permanent life policy. Use that for juniors' college fund. Or if the children decide, hey, I'm just going to enter the job market, or I'm going to go in the military, I'm going to have the military pay for my school, that gives you a lot more flexibility, right? So you can use that cash value for your own retirement, or you may want to, in your later years, may want to start a business, so you can use that to start a business. Build a deck on your house, who knows? There's all kinds of things you can do with that money. All right. So the final question that I get is, okay, well, Mark, with all this said, you've brought a lot of things to the table here. When I start a life policy, should I have, what should be my mixture? Should I have 50% in term, 50% permanent, or should it be 80% term, 20% permanent? How do I do this? And that's when I say, give me a call and let us help. Our contact number is 972-346-4666. That again is 972-346-4666. Or you're welcome to visit our website at www.insurancemadeeasy.us, fill out a form, and we'd be happy to get back with you. Thank you, folks, for listening to this presentation. We'd be happy to serve you. Thank you. Bye-bye.